Good evening, everyone. I'm Sue Herrera, in tonight for Susie Garib.
And I'm Tyler Matheson. Welcome, everybody. It is almost here, and the world awaits. The Federal Reserve kicked off its two-day policy meeting today. By this time tomorrow, investors the world over will know whether Ben Bernanke and his fellow Fed heads will slow the pace of their bond buying. Now $85 billion a month designed to help the economy. So here's what the waiting looked like today on Wall Street. The Dow adding 35 points. The Nasdaq up 27, closing at a fresh 13-year high. And the S&P 500 was up 7, closing above 1,700 for the first time in 5 weeks and closed higher for the 10th time in the past 11 sessions. So will they or won't they, and what do the experts think will happen? Just out today, a CNBC poll of Wall Street pros predicts the Fed will pull back on its stimulus plans by about $15 billion a month. As for when, a majority of respondents say the Fed will start the tapering tomorrow.
And here with his perspective on tomorrow's big Fed announcement and how you should position your portfolio is Russ Koesterich. He is the chief investment strategist over at BlackRock. Welcome back, Russ. Good to see you.
Sue, thanks for having me.
Are you one who thinks that the Fed will begin to taper, and if so, by how much?
Probably, and I think it's going to be a modest tapering, which would mean somewhere in the neighborhood of about $10 to $15 billion. Starting the process, but also recognizing the economy is still getting back on its feet. The labor market is healing slowly, so I think the Fed is going to be very measured in how they withdraw monetary accommodation.
So, Russ, if this happens as you predict, what is likely to happen in the markets, stocks and bonds, and what should I do with my money?
Well, I think a couple of things. First of all, the amount of taper, again, based on the poll you just referenced, I think is fairly well discounted into the market. So if the Fed does go about $15 billion, I don't think that is going to provoke much of a market reaction. There'll obviously be color around that guidance, which might move investors one way or the other. But I think the reality is slow. Now, steady may not be the right word because, as we've seen, we're likely to have more volatility in the bond market given investors adjusting to less monetary accommodation. But we don't expect rates to melt up. So as a rough gauge, we think rates will rise towards the mid-threes in 2014. The market can live with that, again, assuming it happens in the context of a normalizing economy. I think the risk is if rates back up too fast, and obviously the Fed knows this, you run the risk of impeding the housing recovery, which really is the one unambiguous bright spot right now in the U.S. economy.
Russ, you mentioned sort of avoiding interest rate sensitive stocks and leaning towards, I believe you said, more cyclical names. Could you give us some examples, without naming names particularly, but
Sure,
of where you find those interest rate sensitive stocks and where you find the ones that you should lean toward?
So let's start with what we think you want to be cautious on. So historically, at least, the parts of the market that have been the most sensitive have either been bond market proxies. In other words, stocks that generally trade like bonds. I put utility companies in that category, and also parts of the market where leverage is very high. So again, companies that have high leverage levels are, of course, going to be more exposed as the cost of money goes up. What typically is going to that are more resilient in a rising rate environment, and companies that will benefit in the form of faster top-line growth as the economy heals. And I think in that category, I'd include technology companies, energy companies, also some manufacturing companies, particularly those that are likely to benefit from lower U.S. domestic energy costs.
All right, Russ, we'll leave it at that. Thank you so much for joining us tonight.
All right.
Russ Koesterich,
Sure,
he's Chief Investment Strategist over at BlackRock.